How's it going? Happy almost Labor Day weekend.
Happy Labor Day weekend. We're almost there. A
We
couple more
are.
hours.
We're so
A few more
so
hours.
so so close, so close. I sorry for the late start. Our plan was we were flying direct from Austin to Boston. We're going to do a just a beautiful like 2:30 3 p.m. direct flight. Get in a little bit late, but oh, it's gonna be awesome. Well, flight got canceled, and so the only direct flight out of Austin today was a 6:30 a.m. flight. So it has been quite a travel day. So I'm happy to be here, and I'm happy to talk about our topic, which is move up, debt consolidation. Sounds like a really scary, intimidating topic, but I think that it'll hopefully get folks who are sitting on the fence about whether or not they should, either list their home or buy a new home. It'll get them off the fence and ready to get into the game. But
Yeah,
if
this
you
this
haven't,
is go ahead.
go ahead. I'm sorry. No, you go. You go.
Yeah, this is actually a really interesting topic. When you introduced it to me a couple weeks ago, I was like, it seems a little heady, but it's actually, I think, something that a lot of our potential clients and current clients can really get a lot out of. And
Yeah.
also Americans in general. If you have any debt at all that is not house debt, then this is going to be a very interesting webinar for you.
Yes, absolutely. Absolutely. And if anyone has any questions, please make sure you put them in the chat. And this is First Friday Real Estate. Ashley, you want to give the same brief speech that you've given for almost a year now?
Yeah, actually, I think we're on number 14. So it's been doing it for a little bit over a year
Wow,
now. Can you believe it?
crazy.
Um, Hi, I'm Ashley Smith. I am a realtor in Atlanta, Georgia. I focus on Lake Lanier and luxury properties. However, I serve a wide range of people in different price points, different times of their life, and all over everywhere. Actually, I've got a big network of agents across the country and even across the world, which is great. And so I really like to consider myself in real estate a dreamsmith, where really helping you to meet your dreams of what's necessary for you to take the next step in your life, whether that's upsizing, downsizing, or finding homes for your kids, all of the above.
Yeah, absolutely. And like you said, Dreamsmith, what does a smith do? Well, makes dreams. So, and hi, I'm Parker, producing branch manager with American Financial Network. Um, if you've this is your first one as a former teacher and principal, did grow up in the business. My dad did his first loan when Jimmy Carter was president, and Ashley and I have worked together for years now, whether it's in education or in the wonderful world of real estate. So let's go ahead and dive right in. Move up, debt consolidation. Ashley, you want to kick us off with what our overview is going to be today?
I would love to, but I can't see the slides at all.
Uh-oh, well, Jimmy, I'll take this one and then we can
I mean,
I'll throw it over to the next slide.
I can't see them,
Oh,
which
well, I'm
probably
sure.
means our viewers can't either.
Well, I'm sharing the screen. I would hope.
Hmm.
Let's see here. Let me make sure we're in the right tab. All right. How about now, Ashley? Can you see it
Oh yeah,
now?
I can see it now.
Ah, there we go.
Great.
The correct tab. All right. So now, Ashley, talk us through the overview.
Sure. Yeah. So this is, like I said, going to be a really interesting webinar for people. If you have debt, if you're in debt, and you own a home, you might be thinking to yourself, should I sell my house because I have a really low interest rate, right? 3% ish. I got it during COVID. Why would I buy a house now for 6.5%, 7%? But if you have debt, really, this is a very compelling story that we want to tell you of how you could potentially consolidate that debt and then have fewer monthly payments, or lower monthly payments. So I'm really excited to share about it. And Parker is going to spend the first pretty much half of the webinar explaining the current situation of where people are in general with their debt situation and the loan to value of homes. We're going to talk about what it really means to have a 3% mortgage rate. If you have debt, also, do you really have a 3% rate? And then some real life scenarios. So definitely stick around for the end. I don't think this will be as long as a normal webinar that we do. So I think it'll be really exciting to see two different scenarios. One, if you refinance your current home, and then the other would be buying a new home that maybe costs significantly more than what yours is worth now, but even with the higher rates could be a better option for you.
Yeah, awesome. Well said. And I think out of all these bullet points, the one that I feel the most passionately about is the do you really have a 3% rate? Not to spoil it too much, but if you have a really low interest rate, but you're also making hundreds, maybe even thousands of dollars a month in interest only or minimum credit card payment debt, you really actually don't have a 3% rate. And we'll talk about what that means here in just a second. So let's talk about less savings, more debt. Oh my goodness. This is pretty depressing, Ashley, but you're probably seeing it, if not feeling it. I know I'm seeing it and feeling it. And here's what this means, what these charts mean rather, is that we are having ever since COVID, which is what this gray bar is right here, you had savings go way up. Why did savings go way up? You had a lot of different government stimulus money that was coming into households every single month. So people were able to save, but then guess what happened? The stimulus money, it dried up, inflation went way up, and savings started to plummet. Not only that, but look what happened with debt after COVID. Debt is now at a record high. The average car payment, $800. That's doubled in just 3 years.
Is that
And
for one car?
yeah, the average car payment is now
Wow.
$800. Isn't that
Wow.
crazy?
Yeah.
And then 17% have of car payments are now over $1,000 a month. So
Wow.
life is just more expensive, and people are having to burn a lot of cash to save up with how expensive life has gotten. Um, but what this has to actually do with the average loan to value of homes. Let's talk about this. So we have this chart right over here, or not this chart, this blurb right here. It talks about average equity for a cash out refi. So on average, folks have about $185,000 to $231,000 in equity that they could actually access. Okay. Ashley, you did a lot of research and digging in. I know you said you thought this was a little bit heady and then you kind of came around. What about this slide to you really sticks out?
To me, I see that just in the past 20, not even 20 years, it seems that the majority of people have less, um, wait, this says average loan to value. I was thinking maybe that meant they had less equity in their homes, but maybe now they
No, they
have
got more.
more. That's
Yeah, we
great.
actually, yeah, absolutely. Because life's gotten more expensive, but also that means houses have gotten more expensive, which means that the actual equity that folks have in their homes has gone up a ton. So it's not all bad news.
Yeah, and I mean, I think, usually probably your equity is not going to increase as much or as quickly as this chart shows in a normal world where all the home price, uh, the home price appreciation is going up at a more normal rate. But now, since it went up so much more over the past, what, 3 or 4 years, we're
Yeah.
seeing even higher percent of home equity. Is that how to read this?
Yeah, that's exactly right. So in 2008, the average person had about 19% equity share in their home,
Hmm.
right? Um, yeah. So, but here's what we do. Like, but do you actually have a 3% rate? Because while that slide previously was showing is folks have equity to access. So what are we actually doing with that equity? So this is, I think, really, really fascinating and what I want to push people's thinking on. So, and I will say that I'm working with a borrower, or sorry, I was working with a borrower, and this borrower has I think actually slightly less than a 3% rate on their home. And they really, really want to move to be closer with their grandkids in a different state, but they feel like they can't because they don't want to give up the 3% on their current home. The problem is that they are paying a ton of money, and I mean a ton of money towards minimum credit card payments. So let's just say that you have a mortgage of 343,000, and let's say that's at a 3% rate. But let's say that life got expensive and you've got 20, 40, 50, 65, $68,000 in credit card debt or high interest debt. And you can see the different interest rates to the right, 24%, 22%, 21%, 22%. So what does that actually mean? Well, what that actually means is that you don't really have a total loan amount of 343,000 at a 3% interest rate. Really, if you think about total debt, you actually owe 411,000 and your blended rate is a 6.331. And actually, I don't know if you know this, but with rates actually having gone down this week, you could actually probably get somewhere between a 6.5% and a 7% if you put a little bit of money down. So to answer your question, like, do you really have a 3% rate? Well, if you have any other forms of debt, that debt probably has a higher interest rate than your mortgage. And so that's where you really need to look at the entire picture. Ashley, what were some takeaways you had when you were putting together this slide in this chart?
Yeah, that's exactly what you shared is my takeaway. But we actually had a question just pop in about this slide, if you'd
Oh,
like me
nice.
to ask.
Yeah,
And it
please.
is, I wanted to refinance, or I think this person actually said they wanted to get a new mortgage. They're going to get a new mortgage,
Okay.
and they their lender told them that, of course, with all the credit card debt, that their credit score is not as good. They don't pay their credit cards as often as they should because it's a lot of money that they've got to pay every month.
Right.
And so they're wondering if they could pay this down somehow, then would they have a better interest rate? Because you were saying like some people can get like a 6.5 rate right now. Would that be
Yeah, yeah.
dependent on, I think the question is, it's a little complicated, but I think when I'm reading it, the question is, can this debt, if they're paying it, if they can't pay it on a regular basis, is there some way they can pay it down? And if they pay it down, can they get a better interest rate because they have a better credit score?
Yeah, absolutely. So a really popular reason why people do a cash out refinance is they do want to pay off their debt.
Mm-hmm.
And usually when it comes to your credit score, it's impacted by the credit utilization percentage. AKA if you have so for example, this Visa card right here, let's pretend that the balance is 20,000. Um, but let's also pretend like the actual max limit is 20,000. That means that your utilization is 100%. So you're going to get dinged for having that high of a utilization. That being said, if you were to pay that, not even all the way off, but just paid it down to where were using 30% or less of that utilization, then that would have a huge positive impact on your credit score. So yes, to answer that question, if you do already own a home and you're able to access that equity to pay off that credit card debt, then yes, your credit score would go up. And if you have a higher credit score, then you will get a better interest rate. If you want to know just how much your interest rate would improve, you can actually Google something that sounds really technical. It's called LLPA, loan level pricing adjustments. So just Google Fannie Mae LLPA chart, and you can actually see just how big of a rate break you can get if your credit is at X level versus X level. So
Cool.
that's a great question. But let's actually see this practice in action. So let's talk about debt consolidation for refinance. So let's pretend that we've got a property that's valued at 550,000 and our loan balance is 296,929. This is our current reality. That means that we have $253,071 equity in that home, and we're at a 3% interest rate. But let's also say, Ashley, what's our debt balance?
80,000.
80,000. Okay.
Credit cards,
So
card payments, all those things you were talking about.
yeah, that's exactly right. It could also be student loans because remember, student loans are about to kick back up
Mhm.
in October. So what does that mean? That means that our total house payment is $1,923 a month, but our total debt payments 1,215. So in terms of actual cash out the door to service your debt or to pay your debt, that is $3,138 a month. So now
Almost double. So it's almost like a 6% or high fives rate, maybe.
yeah, and honestly, depending, and we would have to really get crunchy to figure out what this would be, but you have to realize too that whenever you're making a minimum credit card payment, very little of that is actually going towards principal. Very, very
Mm.
little. So that's the other thing to kind of think about too. All right, but let's make we have a proposal for you. So let's say that we have the same property value at 550,000. Let's say our loan balance is at 376,929. Why is that loan balance higher? Well, you're about to see. If we tap into or access some of the equity in our home, so we still have a healthy amount of equity, 173,000, but we use that equity to pay off our debt balance.
We
What is
used the
that going to do?
253,000 and we said, okay, I'm going to use some of that 253,000 to pay off this 80,000. And that's how we got the 173.
That's exactly right. That's
Okay.
exactly right. And that could be a cash out refinance. It could be a home equity line. But we're consolidating our debt. We're paying off this debt. But look, oh my gosh, Ashley, there's no way this is going to be good for us because we're going from a 3 to a
Gosh.
6.75%. Not so fast, my friend. Look at this. Yes, your mortgage payment just went up to $3,019 a month because your loan went up and your interest rate went up. But guess what? You don't have any more debt payments, which actually means you're saving a little over $100 a month. Not only that, but this interest rate is a true interest rate versus over here. I would actually say when you actually account for just how little those minimum credit card payments were actually going towards anything, your true blended rate may have even been in the double digits. Um,
Yeah. Sounds
so
like it.
yeah, absolutely. So this is debt consolidation, sure, but it's mostly for folks to realize don't just think about the interest rate on your mortgage. Think about the totality of your debt payments each month. So, Ashley, you want to read our takeaway square?
Yeah. Yeah. So even though in this scenario, you have the exact same house, but this time you're paying off your debt, you're rolling it into to your mortgage. So even though in this scenario your monthly house payment increases over $1,000 a month, and you're like, whoa, that's a lot. You actually your total payment decreases by $119 a month, which is pretty amazing.
Amazing.
And actually,
And it's
yeah, I was gonna say on the
no,
next
you
slide
go.
we'll go a little bit more into detail about this, but the interest now, all the interest that you're paying or your Parker, do you mind going back? What slide, please?
Oh, yeah, sorry. I'm sorry.
Okay, sorry. So this payment that you're paying every month, $3,019, is a big chunk of that you can write off, and
Yeah.
all of that goes towards adding to equity in your home because unlike your credit card and other debts that you were paying off, those don't those don't appreciate. Those just cost you more and more and more. But this is something that over time your home value is going to go up and it's going to add the $3,000 a month is actually adding to your equity.
Yeah, that's a great point. You're sounding more like a lender than a realtor right now, Ashley, which is great.
Well,
Uh,
it's totally a realtor situation too, because I want people, well, this next slide is going to be the reason why. We'll see.
yeah, and this next slide is why I brought this up as a potential topic for a real estate webinar. All right, Ashley, I want you to actually walk us through the debt consolidation for purchase simulation or scenario.
Sure. Okay, so in this situation on this slide, what you can see so far is the same house. You own this house. It's now worth $550,000, and you've got that almost $300,000 of still to pay off on your loan. You got about $253,000 of equity in your home, and you've got a great interest rate, 3%. But you've said to me many times, Ashley, we just had another kid. We really want a bigger house, but to buy a bigger house, it's going to be a more expensive payment. And the interest rates are so high right now. How are we going to afford this? Well, let's go to click the slide, Parker, and let's see. So we're going to propose that you're going to buy a new house and it's going to be $700,000. So you probably bought your first house for about 400,000, and just over the past 5 or 6 years, it's increased in value to 550. So you already
Yep.
have, remember that appreciation we were just talking about. That's going to continue happening when you buy a home. So now you can sell your house for 550,000 and you're going to buy a home for $700,000. But because you already have this $253,000 of equity in your home, but you're also going to roll your debt balance into that equity. So you actually have a little bit less, 170-ish thousand. Your
So
loan
actually,
balance.
to interrupt just for a second, I just want to make sure. So, okay, so I've got a house that I bought. It's now worth 550,000. I've got 200. So what that means that if I sold my house and tried to buy the $700,000 house, I could technically take all 253,000 and just have that be a down payment.
Correct,
But
exactly.
okay, but what you're telling me is that there actually might be a reason to not use all of that equity as a down payment, but to actually use $80,000 of that money that I'm making on my old house to pay off some debt.
Exactly correct. And actually, if you'll click the slide right there, we'll see in this scenario, that's what we're
Oh,
doing. And that debt balance number should not say 80,000, it should say zero. So Parker, put
zero,
that, yeah, zero, zero. So
zero.
this $173,000 of equity in your home was a full 20% or a little bit more down payment actually, which is pretty awesome and allowed you to still, even though you have this higher interest rate, click the slide, Parker.
Oop,
I think you're going the wrong, yeah.
well, clicking. Okay, there we
There we
go.
go. There we go. So now we see that $0, which should also be on that debt balance line. Your
Yep.
house payment might be a little alarming, right? Now you're going to pay $4,224 a month, which you might say, what? That's so much. We're only paying $1,900 a month right now. But you're not only paying $1,900 right now. You're paying $3,100 a month right now.
Hmm.
Your debt
So really,
payment.
it's only gone up really like $1,000, which I say only, but if I'm going from living in a house that I bought for 400,000 to now upgrading to a house at 700,000, I mean, that's not even if rates were at 3%, you're obviously going to expect to pay more for a house that's more expensive, right? So, yeah, I mean that's really cool.
Yes. And it again, click that slide, please, if you don't mind. Your payment does go up by about $1,000, but now you own another appreciating asset. Remember, you bought your first home for probably $400,000. It's
Hmm.
worth 550. Now you're buying a $700,000 home, which when you're ready to sell that one again will likely appreciate very well, especially if you buy in the right area and for the right price. You're not overpaying for your home. Then you have an appreciating asset and all of your interest can be written off on your taxes as well, which I think is a huge value for a lot of people too. What I don't know, Parker, you probably hear from people more about that than I do. What do they say about
Yeah,
writing
no,
off?
absolutely. So whenever you're paying interest on a car or credit card, that has no impact whatsoever on your tax liability. That being said, whenever you make, so let's say that your tax bracket is you're in the 24th percent tax bracket. Okay. What that means is that for your primary residence, for every dollar you're paying on interest, you actually get to reduce how much you owe in taxes by the percent of that dollar. So what does that mean? All right. So what that means is that if I'm paying 100, let's say I'm in the 24% tax bracket. If I am paying, say if I'm in the 24% tax bracket, if I'm paying $100 in interest, okay, if I'm paying $100 in interest, 24 of those dollars I get to actually take off from my tax liability. Okay. So, yes, at the end of the day, when you're writing off interest, interest is interest. But if your choice is to pay $100 towards credit card interest, that does nothing whatsoever, right? Or to pay $100 in interest on a house that's going up in value, but you also get to write off your tax bracket percent. I mean, that's way, way better than just doing empty interest payments on your credit card. Does that make sense?
Yeah, totally.
Um, okay.
Right.
All right. So now
Um,
talk me through this slide, Ashley.
that slide's not supposed to be there, Parker. I think we're
Oh, okay.
finished.
Oh,
Yeah.
questions. Okay, great. Sorry. All right. Any other questions come in? We had a really good one a couple slides ago.
Yeah, I think it was kind of like a follow-up about same thing. Okay, so if I pay off my debt through a cash out refi,
Uh-huh.
then will I be able to get a better rate on my loan? But you kind of answered that with your answer. The
Yes.
answer was yes,
Yep.
correct?
That's right.
So
Yep.
that's good. Yeah, I'm curious from the audience if anybody is able to type quickly. Do you feel like this would be something that could be valuable for you to know about specifically?
Yeah, that's a good question. Let me try to let's see here. Oh, yeah, Ashley. So here's a question about real estate
Hmm.
perspective. Okay. So if you have somebody who wants to list their home
Yes.
because they want to downsize, all right, and they want to downsize, but when they're downsizing, they're a little bit nervous because the interest rate is obviously going to be higher and their mortgage payment will kind of be about the same for their smaller downsized home than it was on the home that they're trying to downsize away from. So, I mean, if you're in that position, do you still think it's worth? I know I have an opinion on this. Do you still think it's worth listing and downsizing, even though your monthly mortgage payment is not really going to change right now? And by the way, assume that this person has very little debt.
Yeah. Well, it's probably different for everyone, but I think as a generic answer, what I can say is and again, I'm a dreamsmith. So if it is your dream or like your desire to be in a downsized home that is easier to take care of, or is in a location, maybe in a community that has more of your friends or people that you're going to be spending time with, then in my opinion, and usually in the people who are choosing to make this decisions opinion, it's worth it to go ahead and get to the place where they really want to be. That's the first part. The second part is that we all know and believe that at some point in the near future, whether that's next year or whether that's in 8 years, the interest rates are going to go down. So again, especially in this scenario where their payments aren't going to change, they're not going to adversely affect them. Waiting until those rates go down and then being able to refinance doesn't seem like it would be a bad problem for them.
Yeah,
The
no,
main
you
thing is the
read
lifestyle.
my mind.
Yeah.
Absolutely. And not only about the interest rates, but when interest rates go down, and they will, and actually went down a little bit this week, when rates really start to go down, guess what's going to happen to demand for homes? It's going to go up because more people can buy them. What happens when demand for homes goes up? Home prices go up. So if you're this person trying to decide whether or not you want to list your home, so you can downsize, but you're afraid of the rate, well, let's think of it this way. It's called the cost of waiting, which is okay. So if my house is worth 700,000 and I want to downsize to a $400,000 house, okay. Well, let's say we wait until rates go down. Okay, great. The house that I'm trying to sell and downsize from, let's say it went up $100,000, right? Okay, so it went up $100,000. Great. That means we get 100,000 more dollars. But what does that mean about the house you're trying to move to downsize to? That also probably went up. Maybe not $100,000, but it might be close. More importantly, do you remember how crazy COVID was when interest rates started to go low? People weren't able to get a house at list price. They're having to offer 10, 15, 20, sometimes 100K over list price. And so if I'm somebody who my dream is to downsize and to get into this smaller house, go ahead and get a good deal on a house that you love. It's not like you're spending more money each month on your housing payment. It's about the same. And then when rates go down, instead of you having to compete and stress yourself out to go find the house that you like, you're already in the house that you like, and you can just bring your payment down by refinancing. So I completely agree with you, Ashley, and I'm glad that we got to end on that question.
Yeah.
All right. Well, we said at the very beginning that Labor Day weekend was officially going to start when I think this is a national announcement. Labor Day weekend is officially allowed to start now that our First Friday webinar has concluded. So if you were sitting around waiting for this webinar so that you could officially start your Labor Day weekend, um, fight the fight, live the dream. Ashley, always love doing these with you, and I'm excited for next month.
Me too, Parker. See you guys in October.
Yep. See you in October.